Hi, I'm Jason Debono, and you are listening to the Passive Investor Podcast.
The views and opinions provided on this show are for informational purposes only and should not be misinterpreted as an offer to buy or sell any securities or to make or consider any investment or course of action. For more information, please go to passiveinvestorshow.com.
Are you a busy professional looking to diversify your portfolio? Ever wanted to passively invest in real estate but don't know where to start? John Fortes provides you with a guide to passively invest in real estate. This is the Passive Investor Show.
And now, the Passive Investor Show. Here's your host, John Fortes.
Welcome, PI listeners, to the Passive Investor Show. I'm the passive investor consultant, John Fortes, your host of the only ranked podcast for passive investors in multifamily syndications. Our goal and purpose of this show is to be a resource to passive investors and help them master their passive investments in real estate funds. My guest today is Jason Debono. Jason graduated from the University of Central Florida and has since acquired 15 years of experience in the self-directed IRA industry. He has served as both Director of Business Development and Director of Operations for NuView Trust Company, a self-directed custodian with over $1.4 billion of assets under custody. Now, in his role as Corporate Vice President, Jason oversees the day-to-day activities of the company. He is heavily recruited to speak on podcasts and at national events as a subject matter expert in tax advantage investing through retirement accounts. Additionally, Jason has provided continuing education to CPAs, attorneys, and real estate professionals and has been a guest speaker at hundreds of investment events and conferences throughout the United States. Thank you for coming on the show, Jason.
Hey, John, thanks for having me.
I appreciate you coming on. Jason, tell us about your background and how you got here during your 15-year career.
So, I love telling this story because it starts with dad said no, and that always raises some eyebrows. 15 years ago, I was graduating college and I was looking for some real world experience outside of selling clothes at a department store. Went to an internship expo, through the college and met a bunch of companies. All of them were easy to understand, household names, except for NuView. Went on their website, couldn't quite figure it out, called my dad and was like, Dad, this company does something with IRAs and real estate. I don't know much about either. What's going on here? And he basically paused and said, you can't do this. My stockbroker told me that you couldn't do it. And so obviously Dad said no, was much more intrigued about the interview. Learned in an interview kind of really what the company did. And when I called my dad and shared it, and my dad said, wow, I wish I knew about this 10 years ago. That was enough for me to go, you know what, my dad's just like a lot of other people out in this world. And I love the idea of having a product and something that people want. They just don't know it exists. And so I've spent the last 15 years kind of shouting from anywhere possible to help people understand, hey, your retirement plan is not just stuck in Wall Street investments. You can take that IRA, keep all the tax benefits and go invest in Main Street. And that's really what the last 15 years has been all about.
Thanks for sharing, Jason. Now, what's that aha moment like when you come across a new client that's looking to explore that option, or maybe doesn't even know this industry or this part of the world?
Yeah, it's a little bit of all different types of reactions. I mean, obviously, my dad was at one extreme, right? Like, oh my gosh, I was told I couldn't do this, so he was more surprised. Most of the time we get a lot of people that say, I've kind of heard of it, but I just didn't know it was really possible. Someone mentioned it, but I didn't quite know the underpinnings. And so we kind of liken it to it's like finding a great new restaurant, with a great new menu. And if you don't go out and look for it, you may just think that your options are, Burger King, McDonald's, and Wendy's, and you just may not know there's options beyond that. And when you find it and you get a taste of the food, you realize, why haven't I been eating this stuff all along? And that's kind of where our business is today.
I love that. So let's jump into the different type of products you have. What is the difference between a self-directed IRA and a standard IRA?
Yeah, so self-directed IRA is really an industry moniker. It's not an actual legal type of IRA, meaning, the IRS doesn't publish a self-directed IRA guideline. So they publish 4 different types of IRAs: traditional, Roth, SEP, and simple. And you can custody those per the IRS's guidelines at any brokerage, bank, or trust institution that meets the criteria. Most IRAs are held at banks and brokerages. Well, banks and brokerages do what? They hold public stuff. They either hold cash instruments, i.e. a bank, CDs, money market, or they hold public securities, which is all brokerage based. So most people hold their assets there and kind of think that's all that exists. And so a self-directed IRA is really going to that third leg of the stool in terms of who can hold an IRA, which is the trust side, and letting that trust company, who has no tie to cash, meaning we're not a bank, so we're not tied to cash or money market. We're not a brokerage firm, so we're not tied to stocks and bonds. We have no investments to offer. So we give our clients the full spectrum of choice, including things like real property, promissory notes. We, obviously talking about syndications a lot, gold and silver, you name it, you can do it in an IRA.
And what is the difference between passive and active investing in a self-directed IRA?
So I love this question because I think there's a lot of ways to talk about this. And when we talk about investing, and forget about asset class for a minute, whether it be real estate or stocks and bonds, think of it like active investing would be like going on to the publicly traded equities markets and identifying the stocks you want to buy. So researching, right? And I'm going to buy Apple, and I'm going to go buy, Microsoft, or whatever those stocks may be. And regardless of the asset class, that takes a lot of work and understanding, right? Passive investing says, I kind of like those asset classes, but I don't really understand a lot about them. So I'm going to go buy a mutual fund. And a mutual fund is where I put my money into a fund that buys a bunch of those stocks for me. So I don't have to go buy the individual stocks. I simply get to go buy one fund that has large cap stocks. And I know that I probably own a little Apple, a little Microsoft, a little Walmart, et cetera. And so that's really what passive versus active is in the way that most people understand it. When you get into the alternative investment space, the publicly traded security space, the asset classes grow significantly. It's not stocks, bonds, mutual funds, really. If we think about asset classes from a diversification standpoint in stocks, you're not diversified. You're just buying different businesses, but they're all stocks. Your asset class is the same. In the alternative world, there's a million different ways to invest, right? Real estate, private notes, private companies, and the like. So when we talk about active investing in a self-directed account would mean going out and finding first the asset class you want to be in, right? Do I want to be on the lending side or debt side? Do I want to be on the equity side? Do I want to own physical land? Do I want to have something that's rented and deals with tenants? Do I want to buy for appreciation? I mean, those are all decisions. So as an active investor, you'd be responsible to make all of those. So you've got to go figure out, if you decide you want to own single family, what city? Once you decide what city, what town? Once you decide what town, what neighborhood? When you decide what neighborhood, what house, right? And you're in charge of all those decisions. And for some people, that's awesome. And for a lot of people, that's daunting, but they like the asset class. So the second way is you can go find, much like mutual funds, there's a lot of syndications that syndicate out assets. So if you like multifamily but have no understanding of how to go buy an apartment complex, right? There's syndications that can do that. If you want to own single family rentals, there's syndications. And so you're investing into the manager, just like a mutual fund. You're really focused on who's the fund manager and what's their track record. And then they go pick the assets. And it works the same way in real estate or any other investment. So you can choose to either go find them yourself, do the research, right? Or you can really invest through someone else who will do all the legwork and research for you and buy the assets on behalf of all the other investors.
If I can just boil down to real basic real estate terms, active is, for instance, I'm the house flipper. I just go and flip the house myself, pick it and do it and use the self-directed IRA to do that. And then there's also the passive side where I lend the money to the house flipper who is going to give me a return on my investment as they'll go and do the work, right? Do I got that right?
You do, and there's actually a third really element to a kind of there's active, as you declare, mention, which is right on, and passive. Then there's like passive 2.0, which is, in that scenario, you like the house flipping, but you don't want to be the house flipper, right? So you lend the money to the person with experience. The third way to kind of do that in a passive role is you like the asset class, but you don't know enough to know about that one deal. And you feel like, I just don't know if this deal's good. So instead of going to loaning your money to the house flipper, you actually go invest into a syndication that may be $10 million that's flipping 100 houses. And you're not having to worry about one single solitary house and its ability to be flipped. You're now spreading that out amongst a variety of houses. So, passive passive can be as deliberate as investing one-to-one, but through someone else. And passing can be as truly passive as investing into a bigger conglomerate of the same asset class. And the beauty in self-direction, and this is why I love what we do so much, is you get to pick which one of those people you are.
I love that. You can pick any one of those hats, and in whatever way it fits, you can just drive that, and you can drive that investment into that direction. I love that. Thank you for breaking that down, because I wanted to give it more of a hat, like a 3,000-foot overview of the flipper, using the flipper model, because that one really just paints the picture of how active do I want to be and how passive do I want to be. And thank you for bringing up the 2.0. I love that concept, man. All right, Jason, what's the most unique investment you've seen a client make out of a self-directed IRA?
Well, and this is such a fun question when I get it, and I appreciate you throwing me for a little loop here, because there's so many unique things that we see, and it underscores the fact that self-direction is not a one size fits all. You can buy anything literally, as long as you're not investing with yourself and most of your family members. So I think I'm going to answer it as two, and I don't know if that's allowed, but unless you're going to mute me, I suppose I've got the floor. So the two, I think one is burial plots. As crazy as this sounds, a lot of people buy burial plots in advance. It's not uncommon. So if you grew up in a town, and if you think about kind of the nature of cemeteries, there's just only so much land. There's a finite amount of space, and depending on the town and the cemetery, they're going up significantly in value. And we had a client that bought up a handful of them, and he did incredibly well. And I didn't realize that you could buy it in like a deeded manner, like you could, and ultimately sell it. So that's one. I guess I probably started with the more morbid of them. So I apologize for that part, but it shows, every little bit of land has value, regardless of its use case. And in this one, obviously, there's only so much of it. The second one is a racehorse. It's not a Belmont Stakes level racehorse, but from what I understand, that this was a horse that was bought, from a great bloodline. The individual bought it with an IRA. And then there's a company, if you will, groups that actually will take these strong bloodline horses, and they will train them and jockey them and get them ready for racing. And you enter into this agreement. They take care of all of those things. And so it was pretty cool. And the horse has done okay. It, like I said, never made it to the big leagues, but it's done well. It's won races, and I think overall it's turned a profit. So kind of a cool thing to hear about, because you watch it on TV and you don't quite understand the underpinnings, and to see someone actually invest into it was pretty cool.
Wow, I know you've mentioned the morbid one, but even in death there is a business, unfortunately.
Right.
But the racehorse is intriguing, because depending on how successful they are, they could go ahead and mate that one and build a business that way too. It's tons of ways to build a business in this country. It's amazing. But also, I use that question to set up this question: is what are the different things you can also invest in using your self-directed IRA?
So our client base really owns three predominant asset classes. Now, keep in mind, there's hundreds of investment strategies inside each asset class. So about 1/3 is real estate. And when I say real estate, obviously I mentioned, burial plots. We have clients that have bought, boat slips and, single family, multifamily, you name it. If it's got a real estate, parcel to it, it falls into that category, regardless of whether you buy it, flip it, sell it, rent it, it doesn't matter. The second category is private notes lending. And so this is people taking their IRA money and lending it out to another party. So to your example earlier on lending it to the house flipper, right? That's a very common kind of mortgage approach that we see, probably the most popular inside lending. But we see personal loans. We see loans on, boats and cars, and we see loans on lent to businesses and bridge financing. We see loans to liquor licenses and bars and things that have value that not many people think are good collateral, but can actually really strongly secure loans. So debt of any kind is kind of the second category. The third is private equity, and this would be where syndications would fall. So even though syndications a lot of times are real estate based, technically the investment would be considered in private equity because you're buying a share or unit of the ultimate investment fund. And so it could be something that is a real estate fund, right? Multifamily, single family. I mean, we used some examples earlier. It could be a true business. So, if you kind of think about Uber, everyone kind of knows what and who they are. But up until, a year ago, they were a privately traded company. So if you wanted to buy, you couldn't go access them. Now, you couldn't also just go invest into them, but they did multiple series of offerings. And so if you were around them and someone you knew or had the ability to understand and make an investment, you could have done that in a self-directed account. So private equity, true private investments. And then there's funds that loan money to businesses. There's funds that own businesses. I mean, you name it, there's probably someone has put together a fund to go out and capitalize on it from an investment standpoint. And all of that falls under private equity. And then there's a small little sliver of what we would kind of refer to as everything else. This includes tax liens, tax certificates, gold, silver, platinum, physical precious metals, cryptocurrencies, the racehorse, right? This is really all the stuff that's just, we have a lot of clients that do it, but it pales in comparison to the real estate and debt and private equity asset class.
Hey, real estate investors. Did you know that you can invest in real estate with your 401k or IRA? Through NuView Trust Company, you don't have to worry about the volatile stock market to make smart money moves. NuView has a free self-directed IRA guide you can get right now. That's right, PI listeners. I said right now. Go to NuViewTrust.com to get your hands on it and learn more. Since their founding, NuView Trust has strived to provide clients with the broadest possible choices in their IRAs. So head to NuViewTrust.com to download their free guide that could help you invest your retirement account in real estate and much more. That's NuView Trust.com. NuViewTrust.com. The more you know, the more we grow. Happy investing. I want you to kind of just walk with me down this little road that I'm going down. I'm going to paint a picture and then I'll follow up with a question. Just bear with me here. So I'm a client. I come in, I set up a self-directed IRA. I go and invest in a multifamily syndication. What is the difference between the profits and the contributions for my account that I set up?
Yeah, great question. And this is something that trips a lot of people up. So, I appreciate you asking that so we can kind of unmurky the waters here. So when you, there's, and I'm going to add an additional term in there if that's okay. So when you put money into a retirement account, and that can be really through two primary ways. One is you write a check and contribute, or two, it gets put in through payroll deduction in a 401k. Right? So your employer takes it out of your paycheck and adds it to your 401k. In either scenario, those are considered contributions. That's your money leaving your personal taxable account and entering into a tax advantage retirement account. That is, those contributions are limited based on the account type that you have. So some account types have a $6,000 limit. 401ks have a $19,000 limit. SEP IRAs have a $56,000 limit, right? So understanding the type of plan that's right for you is certainly something that you're going to want to take some time and understand. But that's a contribution. That's your money being added to it. So yes, there are going to be some limits that you're going to want to be mindful of, and you want to understand what plans exist, and you want to go to the one that you think is best for you, that gives you the most contribution ability. Once the money's in the account, then we're going to, the kind of term I'm going to introduce is two-part. It's transfer or rollover. This means you're moving money between whomever's holding the funds on your behalf. So a transfer is IRA to IRA. So if you put your money into an IRA at Fidelity and you decide you want to move it to NuView, when you put it into Fidelity, that was a contribution, right? You added money. But when you move it from Fidelity to NuView, that's a transfer. There are no limitations on transfers in terms of your ability to do it, the timing in which you do it, or the dollar amount in which you move. So you could transfer $1 every day. Now, you'd probably drive our ops folks and Fidelity's ops folks crazy, but in theory, you could move $1 every day, or you could move $1 bazillion as a transfer. It's just custodian to custodian. A rollover is when you take money that's sitting in an old 401k and move it to an IRA. So 401k to IRA is a rollover. So you're going to, you worked at AT&T for 15 years. You've got $200,000 that's been taken out of your paycheck over those years. That money is your contribution. That's what was withheld. That was your money that got put in. When you leave that employer and you move that from a 401k to an IRA, that's simply a rollover. There is no limit, meaning the amount that you can do, but you typically are not eligible to roll it over until you leave the employer. Whether you get fired or quit or furloughed, doesn't matter, but you can't move it while you're an active employee as a general rule. There's a couple exceptions to that. Rollovers, much just like transfers, they're not reported, they're not taxable, there's no implication for it. You're just moving it from one place to another, and there's no limit. Profits have to do with the investments that you make generating return. So if you were to take your IRA, so let's just walk through the scenario. So you work for AT&T, they took money out of your paycheck every week, right? And put it into Fidelity's 401k plan for you. That's your contribution. Over the years, you accumulated, again, 100, 200, it doesn't matter, $1,000. You left AT&T, you did a rollover of $100,000 to NuView, no tax, no penalty. And then you took the $100,000 and you invested into a multifamily syndication. No limitations, because it's just simply an investment inside the plan. You didn't take it out. If that syndication is the best investment in the world and it doubles overnight and they send you back 200, that is, number one, 100% as a general rule, tax-free back to your account, unless there was some leverage, and that's a little bit of a more advanced topic, but as a general rule. Number two, there's no limit on how much you can put in through profits. So a lot of people think, well, if I make an investment and my contribution limit's only $7,000 and it goes up $10,000, what happens? There's no limitation on the amount of profits you can earn inside an IRA, and the tax advantaged growth has no bounds. So you could turn $1 into $1 billion in a Roth IRA, 100% tax-free forever.
I love that, because the fact that that question came from one of my investors, and I reached out to your team there, and they were awesome at providing the response, because that's something that is kind of the gray area, because of the fact that the conversation behind UBIT and taxes always comes up. So it's the difference between contributions and profits is really the murky waters. Thank you for literally clearing the air on that conversation.
Well, it comes up a lot. We answer that question frequently, and a lot of people, a lot of times we run into is there's just not a lot of understanding of the terminology, and it's just because they don't deal with it very often. So we see it especially between IRAs and 401ks. Someone will say, I have an IRA, and they'll send you their paperwork and it's a 401k, or vice versa. We tend to use them interchangeably, even though they technically are very different plans.
Love it. Love it. Love it. Now, with all that's going on with the world right now with COVID-19, what impact has COVID-19 had on the investment decisions your clients are making today?
Yeah, it's had a lot of impact, and obviously, I can only speculate I can't speak to certainty, but there's a few things. And I think, what our clients are doing today is much different than what they did in March, and what they'll do a month from now will be different than today. For the first probably 2 months, we saw almost just very little movement on any direction, because I think a lot of people, like myself and probably like you, we were all digesting what was happening. And it's hard when you hear words like pandemic and death and cases and rising, and you got daily press conferences. It's really hard amongst that to say, you know what, honey, I'm going to turn the news off and go search for a piece of real estate to buy in my IRA, right? On top of that, you had a massive drop in the stock market. So for a lot of people that become clients of mine, they have to leave the stock market. Well, when the market drops 30% overnight, you don't want to sell. Even if you love the asset class of real estate, the idea of selling is scary, right? So for about 30 to 45 days, other than what was in the pipeline, it was very quiet, again, on all fronts. After that, then you had the lockdown. So, and at least most states had some form of lockdown in April. And so for a lot of our, clients in all 50 states, but they were feeling that. And so the lockdown caused some activity to go up because now people are at home. They're kind of stuck with nothing else to do, especially if they were working from home. Or they were furloughed or laid off. So now they had access to their 401k. Maybe they liked what we did, but didn't have the ability to move their money. And so we saw a flurry of activity during that, which was a lot of inquiry, kind of what is this? How does it work? And interest. The challenge was people weren't sure where to go put money simply because there was so many question marks. Now, the good news is through that time, the market was making an incredible V-shaped recovery. And so people had a lot of confidence in the market, right? So they weren't necessarily ready to move it, but they also knew that, man, this doesn't seem right. The market shouldn't be going up like this. Let me understand what's out there. Now we're in kind of this environment where, and obviously that's, all subject to change based on a second wave, right? But now you have a lot of people that have accessed their 401k that couldn't before. And you have a lot of people that are getting back to some degree to business as usual in the new normal, right? But they're back to work and they're back to getting out and they feel as close to normal again as you can while still keeping social distance and wearing a mask most places. But now we're starting to see people that are going, man, this stock market just seems like it is completely built on a house of cards. And I'm not a stock, expert. And for full disclosure, honest to God's truth, I sold Netflix, Apple. Oh, it gets worse. Netflix, Apple. What do I have? Netflix, Apple, and Amazon. I sold all of them in the middle of March. If you look at I sold them about as close to the bottom of the V. And, even though people refer to me as a subject matter expert in investing, I can tell you from a stock standpoint, I don't know squat about it. And even if I'm an expert in the understanding of investing, it's just impossible to make sense of it. So we're seeing people now that are going, you know what, this market has gone back. I've recouped all my losses. In some cases, maybe I've made a little bit money or maybe I've gotten close. I just don't want to deal with this buzzsaw anymore, up and down and up and down. So our business is really, really picked up in the last 30 days. And then the last part of that is looking forward. We have groups and syndicators that we have been using us as custodian for many years, and many of them are starting to deploy opportunity level funds, right? What are the new opportunities that an environment like this creates as it depresses prices in certain markets? How do we take advantage of that? So going back to that passive investors, a lot of passive investors saying, I'm done with the market. I'm passive there, but I don't know the first thing about it and I'm getting hammered. I do believe there's going to be opportunities in other asset classes. And so they're moving their accounts to put them in a position to go out and exercise those when the time becomes available.
That's awesome. That's awesome to hear that, people are starting to, wake up to these type of opportunities. Now, what is the average rollover amount that you're seeing during account setup?
So, it varies depending on the type of client, but typically between $75,000 and $100,000. We have clients that have multi-million-dollar accounts, and we've got clients that got a couple $1,000. So you don't have to have a certain amount of money to self-direct, but I think that's kind of the sweet spot that we see is at $75,000 to $100,000. and they go deploy it.
Yeah, I mean, it feels like it falls in line with exactly what we do with syndications, where investors will tell us they have maybe 200,000 to invest, but in all reality, they probably have a million to invest, but they just want to test the waters to see how
Sure.
that one investment before they truly commit to, investing more capital. So it lines up. It sounds right. Jason, we love having you. What's one piece of advice for the PI listeners?
Oh man, this is there's hundreds, and I say that because over 15 years I've had so many people give me advice every day, and I thought I was smart, and every day I realize I'm not as smart as I think I am when I talk to people smarter. So I'd love to just drop all that knowledge, but I think the bit of advice is educate yourself. I think that's probably the thing that I see the most. I mean, I see so many people, the people that build wealth are educated. It doesn't make them smart. And I think sometimes people think those two things go hand in hand. Educated means they took the time to figure it out. Smart means they knew it. But educate yourself. And if you don't know the answer, surround yourself with people that do. And obviously, congratulations to everybody that's listening to this, because you've taken at least a step in the right direction, which is you're not using your time, to listen to music and stuff. While I enjoy it equally as much, there's so much downtime that we have. We turn on the TV and, there's podcasts just like this where you can get a nugget or two. It's not going to change your life overnight, but if you learn one thing here and one thing here, and you listen to enough stuff and you read enough stuff and you put yourself in a position to be educated and be receptive to it, stuff starts to seem a lot easier than it is. And it opens your eyes to stuff that, when I started doing this and I would talk to friends and they're like, my first investment I did was a promissory note, a private loan on a piece of real estate at 14%. And, people are, and this was in 2008, and people are kind of asking me, how in the world someone would pay that? How does that work? That seems crazy. And it's like, it seemed crazy to me too. Once I understood it, it's not crazy at all. In fact, we call that Wednesday in the investment world. So long answer to a short question: educate. Surround yourself with smarter people. Grab a nugget or two every chance you get, and then take action. Right? Education without it is nothing. It's like a library, right? You got to put it to work. Otherwise, it's encyclopedia level stuff, but it's not going to make you wealthy.
Learn and put it into practice. We love that. Jason Debono of NuView Trust Company. How can we stay in touch with you?
Best way, and kind of going on the line of education is our website. It's NuViewTrust.com, NuView Trust.com. On the blog section there, you'll see a series of educational webinars and things we've recorded, our upcoming classes. Take a look there. All of our contact info is on the website as well. And if you want to reach me directly, best way is to email me. It's first initial last name, so J Debono at NuViewTrust.com.
Now, I don't know if you probably know this. This is my favorite question to ask. Is there any meaning behind the company name?
The meaning behind the company name is, yes, there is. When we were really kind of sitting down and going through it, we rebranded the company in 2012 to NuView. And so we were kind of looking at opportunities, and the reason that we went with NuView as one word was, part of that is the marketplace likes creative words, right? They kind of like these plays off of words, and that was one element. But we wanted to articulate in our name what people were really doing. And if you take a look at our logo, to take it a step further, it kind of has that arch with the arrow going through it. And that's really the arch is kind of status quo, right? That's where most people are told they have to live their life, right? Work 40 years for the same company, put money in your 401k and you'll be just fine. And that's the status quo. And we're preached that. And people, unfortunately end up tired and poor, when it comes time to retire. And so the new view is exactly that. It's a new view of the way that you view your retirement strategy, and that arrow busting through that kind of arch is you busting through the status quo. Thank you for asking that. I'll be honest, since we did that in 2012, I think it's the first time anyone's ever asked. I've graciously shared this story, whether they cared or not. But it's the first time anyone's asked. So there you go. You've got the background and genesis of both the name and the logo.
I actually really love how people be able to just create the names of things or why they decided to go with that name. Even if it was called Jason Debono IRA, I would still ask that question because there might be some sort of value or way that you came to that, even though it's just off your name. Maybe it's a legacy thing, right? For instance, we're called the Passive Investor Show. It doesn't get any more basic and simple than that. We know what we want. We know what we talk about. And I love the way you came about that. Thank you for coming on the show, Jason.
Hey, John, thanks so much for having me. Really enjoyed it today.
PI listeners, thank you for listening. As always, we hope this was the best resource for your investment strategy, but also the best use of your time. As much as it pains us to leave you, but you know what time it is. Time to go put this into practice. Till the next time we meet. Happy investing. PI listeners, I'm grateful for your time and I appreciate you for listening. It would mean the world to me if you went to iTunes and left a rating and written review. Let me know how you feel about the show. It really makes a big difference with getting the podcast out there. Don't forget about our Facebook group, where all of our guests are members of. I'll be there to answer any of your questions or even questions you might have for future guests. Subscribe so you can get the latest episodes and our fan favorite quick hitters. Finally, I want to keep you updated, so head over to johnfortes.com and sign up for the newsletter. If you're interested in partnering with me, sign up on the contact page so you can talk to me directly. I look forward to connecting with you. Happy investing.